Hey guys, welcome to this week's episode of the Four Horsemen of Real Estate podcast. We're going to talk about different examples of where to put your money when you're looking to do private lending. We're going to look at three different examples, to be exact, of different types of property where you can invest, what to look for, and what items to be concerned about on this week's episode of the Four Horsemen of Real Estate podcast. And I'm your host, Neil D'Souza. Okay, so what are some of the properties that people are investing their private money, their investment dollars into? We've got a borrower that wants to borrow a second mortgage to be able to pay down their debt. Well, what does the property look like for us, and why is that important? So when we're looking at their home, you've got, in many cases, what's the most desirable? 3 bedrooms, 2 bathrooms. And you've got this nice home on a property, single family, fully detached. Now, can you do other properties? Of course, you can get into townhomes, you can get into condos, you can get into all of those. But we're just going to talk about this single family home, they've got a nice yard, nice backyard. In fact, they've even got a trampoline in the backyard. And I'm just giving you an example of one of the deals we're looking at right now. Because you can lend anywhere. You can lend in major urban centers, or you can lend rurally. Now, many times we like to lend, and when I'm sharing with people and teaching people, we love to lend on rural properties. Why rural properties? Because we find that people like their homes and tend to stay in that home for much longer. And this home in particular is up in North Bay, Ontario. We go ahead and we look at the state of the property, and what does it look like? Is it in good condition? Why does this matter? Well, you want to know how much repairs, because we are investing our money into a mortgage, and we know that if people don't pay, happens with the bank? What does the bank do? Of course, they're going to turn around and sell the property. So you, being the bank, if people don't pay, you're going to turn around and sell the property. So you want to make sure that the property is in a saleable condition. Now, in some cases, you might find a property that's missing a piece of siding, and maybe they need a new roof. And you want to look at all of these different factors. When you look inside the property, what's the state of the house? Because you're getting an idea of how that person takes care of the asset which you're invested against. And so, yes, we will absolutely look at, when you're investing your money, we will absolutely look at, is the house neat? Is it in good repair? Does it need a lot of work? Now, some of those items may be important or may not be important, but overall, we want to know where that fits into it as the overall collateral and how that's going to work when we're looking and assessing at, do we want to put our money into this deal? Okay, now we've got another property in Sault Ste. Marie where this individual is an investor themselves. They bought the duplex with the intention of renting it out and being able to bring in rental income. Now, the property needs a little bit of work on it, but more importantly, they've come to us requesting the money because they're going to be converting it from a duplex to a triplex. It's a regular home in a regular neighborhood, just like a single family home. We care about the roof. We care about the state of the building. It's in around everybody. Sault Ste. Marie, thriving town. This is all important because we know that this property is going to be able to hold its value because it's a property on the rise. So you've got a single family home that was converted to a duplex many, many years ago. They want to convert it to a triplex. Well, before you're going to lend that money, you want to find out, is it even allowed to be able to switch over to a triplex? So we would inquire into these types of questions. Are they going to be able to make it a legal, legitimate triplex, meaning taking that property and making 2 extra out of 1? So maybe the main floor might be the regular layout, and maybe they're taking the downstairs and converting it into 2 smaller units. What's also important about that when you're looking to invest your money into a duplex conversion into a triplex? Who's going to be doing the work? Is the investor doing the work? Are they capable of doing the work? Are they going to bring in another contractor to do the work? Are they going to be getting permits? All of these kind of questions you want to look into and ask before you consider giving money to this type of deal. So now what happens if halfway through they decide something else happens, or something happens to the owner and they're not able to finish? Now maybe they've gone in and they've removed everything and you're down to the bare studs. Now you've got a property with a regular house on the top, but now downstairs it's all gutted. Is the value still going to be there? Most likely not. When we look at real estate and an investment property, will that still hold value and be able, because someone else might want to come in there and go, that's perfect. I'll come in there. I'll bring my money. I'll buy this property. I'll fix it up and I'm going to raise the value, because they know they're going to be able to buy it for cheaper. Now, if you've got a second mortgage on that or a first mortgage on that, you want to know that you're still going to get your money back. And so it's important to know, can you get your money back even if they completely rip out everything in that situation, like down to the studs? Will you still be able to get your money back if you sell it as is? Or will it be a situation where you've got to take more money out of your pocket, go finish the work, and then put the property up for sale, which is something that most people I know don't really want to get into. So you look at that situation specifically and carefully when you're investing your money into a deal like that. So here's an interesting one. I've got a borrower who's looking to get a mortgage on their property, and it's in another province. Now, what are they doing on this property? Really huge property. It's got lots of acreage. It's got outbuildings, like a barn and other things. It's not a full producing farm, but there were three guys, and here, what are they doing? They decided that they wanted to grow some type of plant. They developed this whole business plan around it, only to find out that they weren't going to be able to make a go of it. So two of the partners decided that they wanted to be paid out and get out of that business. Well, the business really doesn't have anything to pay out, but there is this property. So one of the investors agrees that he's going to go in, he's going to keep it, and he's going to, instead of growing these plants, he actually wants to subdivide this land and start selling it out, because there's hundreds of acres on this land. So he's looking instead for a mortgage to be able to help buy out his partners, be able to pay them off some money, and then be able to use some of the money to go towards doing the surveys, doing the appraisals, doing the permitting to be able to, what we call, subdivide the property and be able to eventually get it ready for sale, to be able to sell off those different pieces. There's a lot of different items involved in that. Again, at the end of the day, you want to know that you still have equity in that deal, regardless of all of these things that happen. So in this case, sometimes what you'll see is that we'll do something very interesting as a lender, and lenders do this on a normal basis, where you don't give an appraisal for the entire property. Instead, you might give an appraisal on what we normally call it is primary residence and up to 5 acres. So we don't count in any of the outlying buildings. We're not going to count in the barn. We're not going to count in the stable. We're not going to count in any of these other buildings that are all attached to this property. And we're not going to count in the 400 acres. We're only going to count in 5 acres. So now what's the appraisal based on that amount of property? So that if we lose those buildings, if we don't have the other land, what is just that worth? Again, you're looking at it from the standpoint of what's the worst case scenario. Now, knowing that you've got all those hundreds of acres there, you know that the value of it is still much higher than what you've now appraised it at. And therefore, buying yourself a much greater equity stake in the overall property when you're lending your money out. Now, again, that's not for beginners, but it's definitely an opportunity for people that are looking to lend and invest their money as a private mortgage in rural real estate.
Trust in their word, they walk the talk in the world of investment, they make their mark.